Hi everyone. I was just waiting for David to start the recording, which he has now done. And welcome to this afternoon, as he said, this afternoon where we are here in the UK, to this webinar. But before we start, as usual, may I just draw your attention to the disclaimer that I know you can see on your screen. As you know, trading can be a very risky business, so please don't ever think of using money that you cannot afford to lose. And as usual, we'll be looking at the charts. We're looking through a whole selection of charts today, actually, through the prism of volume price analysis. And if there are any of you at this webinar who maybe have not come across the methodology before, it's all explained in the book on Amazon, A Complete Guide to Volume Price Analysis, where really what we look at is the relationship between price and volume to try and determine not only what is happening at the moment, but much more importantly, what is likely to happen next. And with this book, there is now a companion book which illustrates the methodology using 200 what we call worked annotated examples, and it's across all the time frames. This one that goes with the main book really is based on stocks. It's got a few commodities in and some indices, and there is an equivalent version for the Forex market. What we also use in these sessions, we also use our own proprietary indicators. I know we've got some of our users that come along to the sessions. Some of them may have only just bought one or two indicators. Some of them have what we call the full package of indicators. And I know we also have some of our Forex program students as well. And you may think, well, you know, why, if you're doing Forex, why come along to a session where we're going to be looking at perhaps a little bit of Forex, but also the indices, commodities. I'm not sure we've got time for stocks today. You know, why, you know, what benefit is there, if you like, for someone who's, you know, perhaps focused on one market to come along to this session where we look at across the markets? And the reason is very simple, and that is because with VPA, it's almost irrelevant what the ticker is, you know, what the chart represents, because the methodology is applicable across all the markets. You know, and in all time frames. So looking at a chart as I've got here, I've got the pound Aussie up. I've actually got the NQ up at the moment, as we can see here on the daily chart. It just happens to be the NQ, but the lessons that you know, we can learn from that chart, the VPA lessons, are equally applicable to whether, as I said, you only trade Forex or you only trade commodities. There's also another aspect to this, and that's the technical picture. What we say on the Forex program is that's where you start. That's where all traders start. You start with the technical picture, but you soon you know, pretty much realize that you've also got to look at the fundamental news. You've got to look at what's going on generally in the world, and at the moment it's everything. It's about the virus, but there's a third element, and that is you have to look at across markets, do some cross-market analysis, related markets, because a move that is happening in one market is reflected in another. Sometimes one market leads, there are correlations, there are relationships between instruments, between markets. There are also relationships within the markets themselves, between instruments. For example, the NQ, the ES, or the S&P 500, the NASDAQ, the YM, the Dow Jones. You know, two of those, the NASDAQ and the S&P, they will tend to move together. You do get divergences, relationships do break down. They break down for all sorts of different reasons, but, you know, over time, there are some relationships which do hold and, you know, and continue. And as a trader, you've got to understand those relationships, not only for the relationships that are key to what you're trading, but also look beyond the market that you're trading. So, for example, if you're, what we say to our Forex students is, you must look at sentiment, you look at market sentiment, because there are certain currencies which reflect that sentiment. The Aussie is one such example, the Japanese yen. If you don't know, those two currencies will move because of what is happening in other markets and to do with sentiment. Now, conversely, if you are trading the indices, you're looking at a day trading an index, for example, you will want to know, well, what is the currency, what is happening in the currency market? Is the yen being bought or sold? Sometimes, as we've explained in for those of you who came along, was it last week, David? Sometimes one market can actually lead another, and you can get disconnect, and you can see some very strange things going on in perhaps the Forex market, and the equity markets, the indices were going higher, but the yen was being bought, and then gradually there was a reversal. We saw that last week. Those of you who were with us here last Thursday, we had this dramatic reversal in the indices, as we can see here from the daily chart. Now, I just want to bring up the daily chart as well, because here we are. This was us last Thursday. A very, very, a fantastic day for trading. Huge moves across the three main indices. Sentiment completely overturned. Sentiment has now completely reversed once again, primarily because of the Federal Reserve. And there is a saying, which those of you will have heard, never fight the Fed. If the Fed, the moment they are supporting everybody, well, almost everybody in the markets. The one thing they haven't done yet so far is they haven't bought stocks. The day that they decide they are going to buy stocks to support the markets, because in supporting the markets, they will then support the economy, etc., etc., this market will well and truly rocket. It's not unusual for central banks to buy stocks. The BOJ, they are absolutely stuffed to the gunnels with ETFs. They buy them. They've been buying them for years. The Swiss National Bank, they're some of the biggest holders of US blue chip stocks, such as Amazon, Apple. I think at one point they were the biggest holder of Apple stock. And you can find out which of the central banks actually own these stocks. You just have to go and look up the filings at the SEC and to see, what are they buying and what is their holding at this particular time. What we do in terms of what we look at when we look at this chart, so we're aware of what's going on in the background. How do we apply the VPA methodology? Well, the VPA methodology, as I said, it's this relationship between price action and the volume. And what we're looking for all the time is first of all, we're looking for anomalies, because what we want is we want to try and judge whether the price action that we see on the chart is actually genuine or not, because we all know the markets are hugely manipulated. And if it's not genuine, then something is going to happen. It's either going to come to a pause. Is that pause going to be a reversal? And we actually saw this reversal here. Or is it a pause and we're going to go into a congestion phase before either the original trend, which we have here, which we call our primary trend, is resumed, or is it then going to lead to a deeper reversal? This was just if you like, a shock reversal. And how these play out is they cycle through what we call what are the Wyckoff's 3 laws. Now, Wyckoff's 3 laws, and you apply them at different points of the price cycle. So, for example, when an instrument or a market is in a trend, at the moment it's in an uptrend, what you're looking for is you're looking at whether the effort that is going into this move, in other words, moving higher, is it in agreement with the result? And if it's not, you know that is an anomaly. And what we can see here, and it's not very, let's bring up the volume here. Sometimes you can see this much better on the faster time frames, and David will have some examples with you for you as well. So what you're seeing here is what you often see in these trends higher. You will see volume going in, not huge spreads, but it's in proportion to what you would expect. But what you're looking for all the time is possibly a lot of volume going in, but the spread is not very very much. It's a very narrow spread. So if you've got, in other words, you're seeing a lot of effort going in, but not a lot of results. So that is, if you like, that is Wyckoff's third law. Wyckoff's second law is the congestion phase. So essentially, after the price has paused or as we see here, or reversed, it hasn't gone into a congestion phase. It will often do this. This is a better example here. It will go up, it will pause, and then you have this congestion phase before the trend is resumed. That's Wyckoff's second law. And in the second law, in fact, you get a better example probably on one of the, let's have a look on one of the, let's have a look. In fact, I've got it on my MT5. Here we are. There we are. It's quite a nice example here. This is the congestion phase. In fact, this is the pound Aussie. So as I said, it really doesn't matter, you know, what it is, what the instrument is. But we've obviously had a nice trend lower. Then we've gone into a congestion phase. The longer this congestion phase carries, continues, this is the law of cause and effect. Then when you get the break, either in the direction of the original trend lower, or we actually get a reversal from here, then the further this price will go either in this direction or that direction. And that is Wyckoff's second law. Now, his first law is what is called supply and demand, and really it's where you have the accumulation and distribution. So basically you cycle up in effort and result. You then possibly go into a congestion, moving sideways, and in fact, with going back to the NQ at the moment, no one really knows what is going to happen at the moment. So we could see a congestion phase develop in this range here. You know, we've had the all-time high. It's wanting to get back to the all-time high, but you know, before it either carries on higher or maybe it reverses, we will get a congestion phase. And following on from that congestion phase, that will then could develop into a distribution. In other words, it carries, you get the congestion. The longer it goes on, then that will either act as a platform for a further leg higher, or you will get a reversal lower. So that's what we're looking at all the time. And these three laws cycle through the charts in all time frames. I'm looking at the daily chart. Obviously, this is going to take a long time for these three laws to cycle through, which is why we focus on the faster time frames, because they're easier to see and you see them play out. But all you have to do is extrapolate from the faster time frames up to the slower time frames. It really, you as a trader, you have to decide, or an investor, whether, you know, are you going to be focused on the faster time frames or the slower ones. And I think that's what I want to say at the moment. Is there anything you want to add to that, David? I'll pass over to you. Is that okay? If you've got any questions on anything we say, or you want answers to, or if you have some of the indicators and you want us, you know, to clarify anything for you, please just put your question into the chat box and we will be delighted to do so. And I have just one little story for you today. I had an email, having a little bit of email correspondence with one of the readers of my books. She's just working her way through the Forex for Beginners books, which is for the Forex market, but uses the methodology. And she's been kind of successful, but not, you know, not spectacularly so. And she's been buying the book and she's just feeling her way into BPA. And she actually did her first, took her first trade based on that, where she was actually in cable. She was short, and previously to using a volume price analysis, she would probably have continued on a short position, but she's spotted an anomaly. In other words, there was a very narrow spread candle with a lot of volume going in, and she said, aha, I read about that in your book, and she actually went long on that, and she was absolutely delighted, and I was delighted for her as well.